Hello, everyone. Welcome to Just Invest Today. And today we're going to be talking about this article on Barron's. It's basically talking about 14 contrarian stock plays as Treasury yields rise. And remember, this week has been pretty crazy. There's been like a huge sell off in the market, and people are getting so worried about like technology stocks and all these different types of stocks, and people are thinking, oh, maybe it's just the time to invest in the value plays now because everyone's worried about what's going on in the world and what the economy is about to do. And we've seen treasury yields go up. So in this article, it talks about basically how people, when treasury yields go up, people want to kind of flee from the stock market because now they feel like they can probably get better profit somewhere else. So as the yields go up, as the 10-year treasury goes up, and then bonds are going to be paying out more money, and then they're actually a safer bet than stocks, people are going to be wanting to get out of the stocks because remember, everyone is chasing yields in the stock market right now. The stock market and the housing market is like the only place where you can like get money right now. Like if you really think about it, because everything is just so low right now. Like the treasury yields, like everything else is just so low. So bonds are not going to get you any money right now. So people aren't going to put their money there, so they're trying to find different place to put their money because people are dying to put their money somewhere. So in this article basically talks about 14 companies to invest in, and they think that this is going to have a big recovery. So basically, because when you invest in these types of stocks, you don't have to worry about treasury yields and any of that type of stuff. Like that's not important because we know these stocks have such a huge growth into the future. You don't have to worry about that. So this article talks about the recovery of these 14 stocks because they're going to be a contrarian bet because people are fleeing the market. They're fleeing these type of stocks because maybe they think that the yields are going to continue to grow up, even though the Fed has promised that they're not going to put the 10-year treasury too high. It's going to stay at around 1% and probably won't go above 2%. But still, people are running away from stocks, running away from these companies. And in this article, it even says right now, for now, investors do appear to be putting more premium on near-term growth. And you see that in the market. If a stock does not shoot 30% in like a month, people are running away from these long-term bets. Like, if these stocks are not going anywhere in like 1, 2, 3 months, people are fleeing these stocks. They feel like it's a bad stock. I know you guys have felt this, like because everyone's just really in this market short-term minded. They expect when you invest in a company, it's just gonna go right up right away. It should go up in 3 to 4 or 5 months. But guys, that's not how the market is. Guys, if your stock doubles in 3 years, that's a good percentage. You make like we're at 23, 26%. That's a good percentage. That's like people would die to make 26% in the market. If your stock doubles in just 3 years, you get 26%. And people can't wait. People in this market are fleeing these long term companies, and they're fleeing all the way to these short term stocks that are going to produce huge gains from this. So, and that is actually promoted by Kathy Woods, I believe. And I'm gonna get into a video talking about Kathy Woods in my next video. But for now, we're gonna get into this video. So this is gonna provide an opportunity for us guys for these long duration stocks that we can hold for years and years and years that are gonna provide good shareholder value. So let's see what these companies are that this Barron's article talks about. So let's get into it though. So look at these guys. So but this is what I'm talking about when I talk about this article is that these companies are actually they say they're a contrarian bet and they're undervalued, but I don't believe that right now. NVIDIA, 52 PE. What do you guys think of? I want you guys' opinions on these companies that this article laid out. I think these stocks are amazing, but I don't know if they're cheap enough. So we have to always remember that the price matters with this type of investing style. You can't just invest in a company that that has a high PE unless you predict that this company is going to be flying for like the next 5 to 10 years at that good growth rate, at a high, at least 20-30% growth rate. If you're not going to predict that, then paying too high for a company can ruin your stock market gains. So be aware of that before you just invest into these companies. So we know NVIDIA. We know about NVIDIA, right? It's selling at a 52 PE. Would you invest in this company now? But that's the thing with these companies. NVIDIA, AMD, uh, Qualcomm, like all those companies, we understand that the semiconductor market is expanding and it's getting big right now, and all the cloud computing, computers, stay at home, data centers, like all of that right now is just booming. Gaming, it's going crazy right now. So you can see why these companies are here, because in this article they're expecting these companies to be growing in the future for 5-10 years. So they still think these companies are very undervalued. Even a company like Netflix. Netflix is a very sticky company. Twitter. Netflix is such a sticky company because I feel like they can just raise their prices anytime and people are going to be willing to still pay for it. Some people are going to leave, but I feel like Netflix, there's still going to be a lot of people still paying for it, so you can still see the future growth. But even though they're coming down to a lot of competition right now, it's going to be interesting to see where Netflix is going to be, because they have a lot of competition from like HBO, Hulu, all those companies. Twitter, we've seen what Twitter did. They implemented a new program into like their tweets where you can actually get people to subscribe to your tweets and like get payments from them. So we're gonna see how they're actually expanding their product delivery and they're actually trying to monetize off Twitter, and Twitter hasn't been doing that. Apple, we've seen Apple right now. Lee Lu bought Apple in the fourth quarter, so maybe he still sees this as an undervalued play, which still has a long way to go, a lot of expansion. We know how they have this privacy thing they're gonna do against Facebook. We're gonna see what happens with that. See if that actually benefits Apple at all. If they can like kind of squeeze out more money out of the consumer. Sherwin Williams, Lennox. This is like a paint company. This is another semiconductor company. So you can kind of see the companies. We know the housing market is booming, so painting and all that type of stuff kind of makes sense. Semiconductors, that makes sense. Shipping, that makes sense. Ecolabs, texture instruments, semiconductors. See, Facebook, and this is pretty interesting that they still have Facebook, because Facebook has such a negative sentiment against it, even though it's still growing its revenue like 20%. But still, remember that everything is about sentiment. If people don't feel like Facebook is a good bet just because people don't like it, or people don't like, they feel down on the company, or they don't like Mark, anything about that, people are going to be fleeing from the company, which actually can very strong under provide a very strong undervalued company for us to buy in, because that always reverses. That sentiment usually reverses once it's kind of out of the news and all that type of stuff, right? Because remember, Apple had the same thing. People thought Apple wasn't going anywhere, and that's the time where Warren Buffett was buying the company. But Apple had such a bad sentiment. Everyone thought the company is dead. It's not innovating anymore, and they're just such a old. They're not growing at like 5-10%. And look what happened to Apple. The Apple boomed, and they like doubled. So it's all about sentiment a lot of the times. It's not really about what the company is doing, because if you look at the fundamentals of Facebook and the stickiness of its customers, you understand that Facebook isn't going anywhere in 5 years. So, what do you think about these companies, man? Like AMD, 20, like the duration of their time, forward PE 52, 46, 54, 76, 30, 19, 26. Like these PEs are pretty high. Like if you think about undervalued companies, because when we think about undervalued companies, we don't want to play these high multiples of earnings, because then people are bidding up the price of these companies and they're expecting to get all that earnings in the future. But that's why we have to make sure that we can guarantee that these companies are going to be solid going into the future if we're going to buy it at these high PEs. So what do you think about all these companies? Do you think all these companies are undervalued right now? Which companies would you actually buy into right now? I want to hear what you guys think. Right now, I own Facebook, and I think Facebook is an amazing company. I think it's at least $340 right now, honestly. Like in my opinion, I think the stock's at least worth 340, and that's just like fair value. And it's already selling at like 257 right now, Facebook on the market. So tell me what you guys think. Are you buying into any of these companies? Are you looking into any of these companies? Um, do you see these companies expanding in 5 to 10 years into the future? What are you guys doing? Guys, if you like this video, like, subscribe to my channel, and I'll get back to you in the next video. Peace.